From the opinion pages of the Wall Street Journal, this is Free Expression with Gerry Baker.
Hello and welcome back to Free Expression from the opinion pages of the Wall Street Journal. After a short summer break, I'm Gerry Baker, editor-at-large of the Journal. If you're not already subscribing to Free Expression, please do so at Apple Podcasts, Spotify, wherever you do your listening. And please do leave us a nice review. Well, summer is pretty well over, and there's a lot to think about as the nights draw in and the mercury drops. We'll be covering on Free Expression all the big issues over the next few months, and most importantly, exploring what lies behind the big developments in politics, economy, business and culture, and all those developments that are driving the major news events. We're going to start this week with a look at the economy and financial markets. The post-Labor Day action seems to be focused very much on government debt. In particular, bond yields are rising sharply around the world, once again on renewed concerns about inflation. And they are rising too in the United States, where, of course, people are wondering what Donald Trump may have in store for the Federal Reserve as he continues his effort to fire a Fed governor and then, of course, ultimately to replace Jay Powell, the Fed chairman. Later this week, we'll get new jobs numbers, which will tell us whether the sharp slowdown in employment that we saw over the summer was just a blip or the start of something much more worrying. Donald Trump, of course, has also got to deal with various legal issues over challenges to his tariffs and various other uncertainties. So there's a tremendous amount of uncertainty confronting the economy, probably reflected in the fact that gold is surging, the dollar has been struggling. But even so, stocks have continued to set record highs over the last few weeks. So what's the outlook now as we enter the fall? I'm pleased to be joined this week by Brian Moynihan, Chief Executive of Bank of America. Brian's led one of America's, of course, largest financial institutions for 15 years now, but he started out professional life as a lawyer, although we won't hold that against him. And Brian Moynihan joins me now. Brian, thanks very much indeed for joining Free Expression.
It's great to be here, Gerry. Good to hear from you.
Thank you. And the world is coming back, or the US is coming back from its summer break. Let's look at the state of the economy and markets if we can, we can start off with that. There does seem to be a little bit of rising concern about fiscal positions of governments around the world. European countries, people getting really concerned there. You've seen a lot of increase in bond yields in Europe. Here in the United States, we've seen a little bit of that action. We're recording this now on Tuesday afternoon, first day back after the Labor Day holiday. We've seen a little bit of market reaction, 30-year Treasury yields up somewhat. Again, nothing dramatic, but edging up. What's your sense of what the bond markets are telling us, Brian, right now about the economy, about inflation, about Donald Trump, about everything that's going on? How do you interpret what's happening?
I think the clear message and the clear need for governments around the world is get the fiscal balance better. I mean, that's not new. It's not something we haven't been dealing with. It just got, because of the pandemic and the amount of money it took to sort of fix the whole creating economies, and then frankly, maybe doing more than required, that created inflation. And then there was a lot of borrowing to go on to pay for all that. And now we got to get it all back in sync. And so I think right now, most people are saying in the U.S. case, it's okay. It's not perfect. We should have less debt as a percentage of GDP, all different ways to measure it. The cost of carrying that debt is going up. So we got to sort of get our eyes and stomach aligned and live within our means a little bit better. And that will require either more revenue or less expense, because at the end of the day, we're running about a $2 trillion, $1.8 trillion deficit, and we got to get that closer to break even, as any household would have to do, as any person would have to do. And I think that has to be taken seriously. The ways to do it are to grow your way out of it, i.e. create more revenue and under the current tax rates and things like that, or another way is to take the expenses down. And then the third way is the entitlement costs. And at the end of the day, it'll probably take a bit of all of that. But we got to get after it rather than let it sit there, because otherwise it just gets worse over time.
We're entering another sort of standoff in Congress this month, where the Congress is back. Of course, one of the main things they've got to do is to fund the government. It looks, once again, divided Congress, going to be a hard time doing that. How much concern do you have about what's going to happen in Washington the next few weeks, and whether or not we're going to have, greater uncertainty about that? What are the political conditions in Washington in terms of how they represent any sort of willingness at all to deal with the fiscal challenges?
I think the need to deal with those fiscal challenges is high. It's been a long time since anybody really wanted to deal with them. So if you go back in the President Obama administration, there was a bipartisan commission that was studied the debt, and it came up with a set of recommendations, and Congress agreed that they would adopt them as a package. It didn't happen. I think then, if you move forward from that a little bit, you had Paul Ryan and his work to try to get it straight, and that never happened. And so I think at the end of the day, what you see, you got to divorce the short-term sort of shutdown risk and what if what if somebody makes a mistake and what that could do to the economy. And those are real risks, with the longer term risk of the debt getting above what can be sustained, and then the bond market not accepting the debt at the current levels or reasonable levels. Those are two different things. And so I think you'll see a lot of the politics around the shutdown and everything go on. Hopefully, as has been said by both the Democrats and Republicans when each was in power, we won't shut down the government because we don't think that's the right thing to do. So my guess is a lot of continuing resolutions and things like that. But that's all politics. The need to get the fiscal house in order is important because at the end of the day, the cost of that debt's gone up and will stay up even if rates come down. Some will still be high. And then secondly, the size of that debt has become a concern, and that's what Congress is going after. That's not a continuing resolution, shut down the government. That's a long-term discussion about how to get greater fiscal soundness.
What was your view of the one big beautiful bill? Significant tax cuts, some spending cuts, but by most estimates, adding quite significantly again to the deficit and the debt over the next few years. Was that prudent?
It was tolerable, and the key is it kept the tax rates in place and made some things permanent so people could plan. The inherent decision you're making when you make that set of policy choices that Congress made and the administration made is that you're planning on stronger growth out of that. That's what we got to make sure we get. So I think as we come into next year, 26, we got to see the growth kick back up in the United States because in the end of the day, that's the bet they made. Keep taxes, keep the environment, work on deregulation, and that'll grow. And that's got to do. What we're seeing in the consumer spending and what we're seeing in business enthusiasm is still strong. We need some certainty around the tariffs, and then you ought to expect the economy to grow more and more higher next year and the year after, but still not above trend growth, i.e. 2% to plus on that GDP. So I think as we think about that, the big, beautiful bills, what it did is preserve tax rates, which would, if they would have gone up, that would have created a big problem for corporations operating in the United States, what to do. Once you got over that hurdle, now the question is what happens next will depend on whether the growth comes or you're going to have to revisit how you're going to handle the debt.
We're getting a lot of data, some of it conflicting really on the economy. We saw this pretty dramatic revision to the employment numbers over the summer. We're going to get some new numbers, obviously, for August later this week. Consumer confidence numbers seem to be a little bit weak. Inflation has been relatively benign, although there remain concerns about tariffs. But the bank there, you see the economy pretty much in real time. You're seeing, transactions, credit card activity. You just mentioned it there. Any indications at all that we should be concerned about the strength of the economy right now? Or do you think we're going to kind of just rumble on at this, as you say, maybe this sort of slightly below trend rate of growth?
Let's go through two or three pieces. One is the Bank of America research team, which is one of the best in the world, if not the best. They basically say no recession. The economy grows at 1.5%. more or less this year, fourth quarter this year to the fourth quarter last year, annualized, moves up to 1.6, 1.7, and moves up to 2, 26 and 27. So you see this ascending economy. They think inflation takes a little longer to work out, gets worked out by the end of next year. They think the rate structure, they still are of record that they don't believe the Fed will cut rates. I think the market's challenging that right now. But we're talking about a rate structure that kind of moves with the Fed funds rate around 3% and settles that into that rate structure, which is more what we've lived with most of our business lives. So that being said, the question when you raise things like what does a consumer confidence say, that gets into the question about what people are saying they feel like versus what they're doing. And so what we at Bank of America have is 70 million consumers that go out and spend money every day. We look at it every week. They spend on credit and debit cards, which is only about 20% of the way they spend money. That is $4.5 trillion. And that is growing at 5% plus August of 25 versus August of 24. And it grew faster as we moved into the summer on year-over-year comparisons than it did last year or even earlier this year. So that's good news. And so despite the consumers' confidence ebbing and flowing, and despite what you read about that the consumer is spending and is worried, at the end of the day, they're still going and doing things. And what are they doing? They're going out for entertainment. They're going out and they're booking travel. They're doing things which are inconsistent with a strong worry that might be expressed in a more on-the-couch type of survey. How do you feel versus what do you do?
And just to be clear, Brian, that 5% number, that is a nominal number, right? So that would obviously include the price increases that we have seen over the last year. That's not a real number.
But if you look at it, even in periods of lower inflation stuff, that's a strong number even on a net basis. And you got to be careful because the net gets very tricky. So, in there, you're overcoming a decline in gas prices that is about 5 or 6% of the credit card spending are down 6 or 8% year over year, double digits, and people are respending that on something else. And so, yes, it's not inflation adjusted, but at the end of the day, it's consistently measured. And this is a higher level, even with inflation running in the high to mid twos. When inflation was in low twos, this number was 3.5, 4. And so it's more than the inflation difference.
All right, so let's talk about the Fed. You mentioned the Fed there and the outlook for the Fed. Most economists, maybe not yours, most economists do expect a rate cut this month, another one by the end of the year. The market certainly expects that. I think a rate cut this month is pretty well 100% priced in now in the markets. Is the Fed, in the words of Donald Trump, is Jay Powell too late? I mean, we have now seen the economy slowing over the last few months. You mentioned that even your economists expect sub-trend growth. Fed's kept its interest rate, however, unchanged for almost a year now. Do you have concerns that maybe the Fed's a little bit late to the game?
I think the question is sort of which lens you look through. Do you look through the inflation lens, or you look through the full employment lens, the price stability lens of full employment? And they give you competing answers. The labor market was pretty strong, honestly, and unemployment's very low. And yet you're seeing this noise about all the data and statistics we won't go into, but you're seeing this question about whether, we're seeing a slowdown in the number of jobs created. But even with the restatements, the jobs are growing on frankly, a stable and maybe flattening out growth in the size of the workforce due to the lack of immigration and the other immigration policies. So if you start to think that through, with unemployment rate in the low fours, that is through full employment, and wage growth is strong. And so that kind of plays counter a little bit to the question of whether we form 75,000 jobs or 150,000 jobs in a month. The reality is there's more jobs being formed, and that's a good thing. Now, on the other hand, maybe it's not fast enough, and that's going to be the question, and the productivity of those jobs and what they're doing and everything. So our view is that the Fed has to pay attention to both things. They have to be vigilant on inflation because that's really their sole role. And inflation is still elevated. The question is, when will they see through that it's on its course coming down, which it was, and then the tariffs put a risk around it, but that risk is a risk to still come through the system, honestly. The actual inflation and housing inflation has been coming down. And so I think 25 basis points isn't going to make a lot of difference. The question is, what's the long-term trend? And our team thinks the long-term trend is a Fed funds rate that stays around 3%, and a 10-year it's around 4.5, which is more of a normal yield curve, and a nominal yield curve that is more normal with a growing United States economy in the 2.5+% range as opposed to 1.5%.
Donald Trump is currently trying to fire one Fed governor for cause, as he puts it. That's obviously being litigated. He's obviously planning to replace the Fed chair. Jay Powell's term comes to an end next year. He's looking for someone that seems quite friendly to Donald Trump to replace him. Should we be concerned, and is this to some extent reflected in market activity, should we be concerned that the independence of the central bank is in jeopardy?
The Fed has to be independent. You heard the Treasury Secretary say that this morning or yesterday. That's not a question. The question of the right to reappoint the chair when it comes up next year, that's the prerogative of the current, whatever administration happens to be in power. But so I think the world investors would say that you need an independent Fed. The best countries in the world, the strongest countries in the world, and the United States being in that category in both, has an independent Fed, period, end of story. We need an independent Fed so they can, without the political food fight going on around them, decide how rates should be set based on the dual mandate we've given that Fed. So I think that's the clarity of it. The rest of it, I think, is politics and stuff. I'll leave to other people decide that. But we need an independent Fed, because when you look at countries that have not had independent Feds, and our research team, it has been tough because they've been pushed in directions to do things, whether it's in Russia or whether it's in Turkey or other places. Brazil didn't result in good policy.
You mentioned tariff uncertainty a few minutes ago when you talked about the outlook for the economy. So Donald Trump has obviously imposed these tariffs. We now have this court decision last week upholding the appeals court decision last week, upholding a lower court, essentially striking down most of those tariffs under the emergency powers that the president used to do it. Obviously, this presumably is going to go to the Supreme Court. Even though you're a lawyer, Brian, I'm not going to ask you to handicap the legal niceties here. But what's your general sense so far of the tariffs? And both in terms of the actual tariffs we've seen imposed, which have obviously, as Donald Trump keeps telling us, have produced significant amounts of revenue, not trillions of dollars, as I think he claimed the other day, but certainly a significant amount of revenue, have probably been felt to some extent both by companies and by consumers. So give us your sense of what the tariffs are doing to the economy and likely to do to the economy at the extent, but also this picture, this uncertainty, the on-again, off-again nature of how damaging is it for the economy? I
think if you think about the travel of 4 or 5 months, I guess, and maybe 6, 7 months since they were first introduced in earnest, but from Liberation Day, 5 months or so. If you think about what business have gone through, which is, these things could go in any direction, higher, lower. What you're now seeing is a goalpost to largely form. At the one end is like a 10 to 15% rate, and at the other goalpost is 30, 35%, maybe up to, I was in Switzerland a couple weeks ago, 39%. But, those seem to be the width of the goalpost. So that's one thing. The second thing you're seeing that the clarity of these playing out and deals that are done is providing some semblance. If the UK can do a deal that looks like such, then why can't Europe do a deal that's similar sets of products, similar countries, similar what they do with the United States? And so being in Switzerland a couple weeks ago and talking to people there, there's grave concern about corporations that, does the administration understand this? The answer is they do understand. They're trying to achieve a set of goals, which is money, raising money, getting fairness and balance of trade. You buy some stuff from us or invest in our country and you get lower rates because you're getting advantage of the U.S. market. National security, which is unique to a couple countries, obviously China being one of those. And then jobs back. And I think, the pattern to solve this for a country is actually the known quantities are there. The good news from the business community is you went from over the last 5 or 6 months from these things could get to 145 on China to where now there seems to be a range. Now the question, we just get it done. One way or the other way, and the court introduces it at a risk because at the end of the day, business is now turning to their 26 plans, and they're saying to themselves, okay, I got to do my financial and strategic plans for 1, 3, 5 years, whatever they do. I've got to decide what resource I'm going to do. I got to decide what my cost of goods is, and I got to decide the margin I can put on and what I can price. And they're all sitting there saying, wait a second, I don't understand. So as I've gone to the Midwest and talked to clients, and you listen to them, they say, look, I supported the administration, but I need to get some clarity here so I can run my business. And I think that's becoming more the desire. I'm less certain about it. I understand tariffs are going to be there. I want to know, now how to plan. So give me a number and let me go. And that's what you're hearing more from business. It's not debating the merits. It's not debating that. It's just give me some number that I can then plan on and go with.
We're going to take a short break there, but when we come back, I'll have more with Brian Moynihan, Chief Executive of Bank of America. We're going to be looking at the state of the world economy and financial markets beyond our own shores. Stay with us.
You're listening to Free Expression with Gerry Baker. Don't forget, you can listen to the latest episode anytime on your smart speaker. Just say, play the Opinion Free Expression podcast. Now, back to Gerry Baker.
I'm back with Brian Moynihan, Chief Executive of Bank of America. We're talking about financial markets and the state of the economy. You've been CEO of Bank of America now, Brian, for 15 years. You came in just after the financial crisis. It's been a pretty dramatic time as you're CEO of one of America's largest companies. How do you see the business environment currently? I want to come on to Trump in a minute, but this is not a question about Trump for now. There was a lot of pressure in the last few years before this administration. A lot of talk was about pursuing stakeholder capitalism rather than sort of shareholder capitalism. The banks, major institutions, major companies like your own needed to take into account not just the interests of the maximizing profits for shareholders, but kind of broader societal responsibility, ESG, DEI, making sure that you were contributing to society as well as contributing to shareholders. Again, that was a big deal. I can remember the Business Roundtable coming out a few years ago with a big statement saying that that's what we needed, stakeholder capitalism. Is that all now kind of slightly in the past now that we seem to be in a changed environment, or do you think all that stuff still applies?
But I think in the end of the day, if you think about what has gone on, think about a couple things that I focus on, which is profits and purpose. You got to be able to do both, because at the end of the day, to do both means you're going to be attractive for clients, that you're a good company and do things well and do things that they're interested in, and provide great products and services. You're going to be attractive to teammates coming to work for you, because in the end of the day, they've got to believe in the company they work for. And you got to be attractive to shareholders, and you got to deliver the returns. And so it's profits and purpose. And Jim Collins, a great business writer, wrote about this 30 years ago. It's not a new concept. So as you think about that, or it's capitalism done right. In other words, capitalism without any constraints, if you listen to people, it can lead you to places that you got to take care of the people who fall off from capitalism. So you have the right to have really strong capitalism. U.S. capitalism is unique. The country isn't formed on an idea. This country is not geographic. It was formed on an idea of democracy and the right to choose and self-determinism and all those things. A bunch of people who weren't going to inherit money came here and tried to make their way in the world, and they did a hell of a job, and we've all done it too. So if you think about that, capitalism done right is important, because U.S. capitalism is a superior system. And it's done right, and it creates jobs and opportunity. What I think people react to is where you're trying to engineer outcomes. And that's where I think the debate's got about. If you try to, say, this is the outcome I want, therefore, if you don't achieve that outcome, you're wrong, even if your business model wouldn't support that outcome, even if that wouldn't be the wisest for shareholders. So our job as management of all these companies is to do capitalism done right. And I think if you think about it that way, you can take all these circles and shove them in a pile and end up with one that's profits and purpose, capitalism done right, and it all works.
And now we have Donald Trump, again, very different, and not only different, obviously, from the Biden administration, but different from traditional Republican view of business, which broadly speaking, caricaturing obviously, but within reason, let companies do what they want. We believe in free markets. Donald Trump seems to believe in, the power of government, or at least the power of himself. He likes to tell CEOs what they should be doing. He's just seen this remarkable thing where the government's taken a stake in Intel. He lectured you, I think, earlier this year, complaining about something that Bank of America was doing. He lectures Tim Cook at Apple. He seems to have this very activist idea about the role of government in business. How are you coping with that? And how do you see that in terms of the development of American capitalism? Is this just a kind of a president who, just being a businessman, just likes to get involved in these things? Or is this a pretty sort of radical change that the U.S. economy is going through?
There's a lot of things to it. One is, there's a belief that if we're supporting these businesses through research or through access to markets, maybe we should get paid back as a government for the good of society to give some interest back. If we're going to give a bunch of grants for someone to build plants and stuff, maybe we should get a piece. I can understand that thinking. Inherently, it's against some of the more traditional Republic. I remember in the time of the financial crisis, the idea of the government taking stakes in companies, and they took preferred stock. We paid it back in 12 months. We got away from the government ownership interest, where, the UK, invested in companies in common equity. It took them, they're still not completely out of some of the companies. So I think this idea of, taking interest stuff might be more for, is the government getting a fair deal from activity they're creating, which is not different than, frankly, the left has had over the years in terms of some of their thought process. So I think it's a different day, but I think it comes more from that deal question. And that's when I hear it, than it comes in other things. I think at the end of the day, our company's been around for 250 years almost now, and we've been there for every president, including that one when George Washington left office. Our company came to being, basically. So we're used to dealing with it, and it's a job of our management team, our company, our board of directors to lead our company through all the cycles. And by the way, it's here and abroad. We've had lots of UK prime ministers, lots of French prime ministers, not as many German prime ministers. Think of all the Italian prime ministers. So you think of all the people coming in and out. You got to run the company the right way, and I think that's what people do. And at the end of the day, the people in America voted, and we've got to work with the administration to make it successful. If America's successful, we're successful, and that's what we work for.
On crypto, this is, again, your time as CEO of Bank of America is almost precisely coterminous with the growth of crypto. We've seen as extraordinary growth, trillions of dollars now invested. But the particular angle I'm interested in with you is, some people see crypto as an alternative to traditional banking. And in particular, especially in the areas of credit cards, which are important to you as a payment system. All banks, and more importantly, the payment companies, make a significant amount of money from the transaction costs, if you like. Is crypto going to change that? Are we going to basically be having a very kind of low friction sort of digital currency in the future? And more broadly, what's your sense of where cryptocurrency is heading?
Yeah, I think you got to sort that question into the stable coins, which is a transaction regime, versus some of the crypto, which is a little bit different, more of an investment question. But if you focus on the transactional things, I think this is a serious threat to the banking system. So the stablecoin enablement legislation went through. If you've followed it to what happened in money market funds, you see $6 trillion or $7 trillion of U.S. deposits are in money market funds today, which, to keep them safe, because they aren't regulated in the same way bank is, they have to invest in short-term treasuries and cash, which means they're not doing a lot for the regular economy. Going back to Hamilton and others, the banks were formed, and our bank was, or as part of our company, was formed in communities to take the people's money and hold it in safekeeping, and then turn around and support the growth of the community by lending that money out. If you say on the lending side, all they can do is invest in the government's treasuries, that's not exactly helping the economy move, because that activity is coming out of last year's economy, not next year's economy, frankly. So I think, that's where we got to be careful. It's a threat to the banking system in the sense that it's a new payment system. And as you said, I think the banking system will clearly have its own version of this. I think we have built networks like Zelle, which is already dominating. If we were here 10 years ago, you'd be asking about Venmo, and you guys don't have anything like it. Now, the banking system does 3 times the P2P payments. You can make cross-border payments fairly easily in banking. We can make that easier by connecting the real-time payment system around the world. That's something we're working on, that really set up, and we've got to deliver. And I think the one thing that people should be cognizant of, if you take people's money from them in a deposit form, you have to be regulated, because the trust of the world is given to that person. And if that money disappears through either defalcation, through cyber incident, through whatever, it's not good. And that's what causes the issue. So I think we have to be careful that to store people's money is a regulation. On a pure investment side, you can argue different things, but to store people's money, it has to be regulated.
Yeah, as you say, a stablecoin, exactly that does seem to be the immediate threat that Bitcoin or crypto more generally. Some of those issues about stability and speculative issues probably cast more of a question of it. Question on AI. everybody's doing it. We're doing it in the news business. You're certainly doing it in the banking business. Give us a sense of how far it's already gone in your business, Brian, and how far it will go, and what will be left for humans to do when in the next 10 years as AI advances.
The way we think about AI today is how do you apply this technology capability to actually take work out and then apply the capacity from that work to help grow a company. And that's what we've been doing. So for the last 3 or 4 or 5 years, our headcount has been relatively flat. But if you look at what's been happening with that headcount, it's been deployed to places for growth and taken out of places of cost. Did AI help that? Yeah. Erica, which is our AI agent, which has been out there since 2018, has 50 million customers, have used it 3 billion times. That small language model in today's parlance, nobody would call it back when it was put together. But that small language model, say every one of those 3 billion interactions would have been some kind of face-to-face. So it has great applicability. Meantime, we've grown the consumer business, et cetera. So I think the care for management teams is to think about all those aspects. How do we apply this right to do a great job for the customer and client? How do we apply this right? And how do we retrain our team and reskill our team so that we can have those people going? And frankly, how do we be careful on more hiring to make sure that those colleagues that we bring in will have a career here? We hire for a career determination. So technology has affected these business dramatically. It's a responsibility of management to manage appropriately so that we can get through this. I will back up and give you the broadest perspective. In the late 60s, the U.S. employed 80 million people. Today it employs 160 million people. Think of all the technology that came on from 1969 till now. Unbelievable stuff, and yet we employ more people. So I believe I'm a bit of a glass half full. Yes, we'll take out tremendous amounts of work, but that work will be dedicated to other tasks and potentially turn productivity and speed of the economy up.
Final question, Brian, and sort of wrapping all this together and kind of putting it in a global context too. The US has been the star economic performer for a long time, really, in the world. Europe has been stagnant. China, which was obviously booming in the 2000s, kind of slowed down in the teens and does seem to have a whole set of struggles right now. As you look at what's been going on here in the US, but also in Europe, with Europe sort of trying to invest more, particularly in sort of defense, as you look at what's going on between the US and China, the economic relationship there, what's happening more broadly with international economics, with more competition, if you like, economic force being used as a kind of as an element of sort of diplomacy. Is the US's sort of global economic dominance guaranteed, assured, do you think, or do you think we're seeing some challenges to that and some changes to that?
The word guaranteed or assured would be too strong, because at the end of the day, we're 300 million people out of 8 billion. Some of these economies can grow and create internal markets, which then can create economic engines. But in the end of the day, what America has is a democracy that's lasted longer than any democracy. It has capitalism as an intertwined basis for that democracy, not a distinct one, but an intertwined basis. And it has the ability for people to go from nothing to something. And that self-determination, entrepreneurial spirit, that's what's unique. When you look at other countries, they try to overmanage the capitalistic change, right? In Europe, introducing a lot of constraints on it. So Europe, pre-financial crisis, you and I would have sat there and we'd have had everybody tell us Europe was going to outgrow the United States economy, be bigger. Today, the United States is further away from Europe by a lot than it was then. And China was going to take over. It's the kind of capitalism that's practiced in the U.S. that we have to make sure we don't damage. And so that exceptionalism, that number oneism, whatever word you want to use about it, we started with nothing. We made it here because we let democratic system, the capitalist system, go at it. And that sometimes that was fun, sometimes not so fun, but we have a resiliency to come through. And I think you've seen that post-financial crisis, our economy is back and roaring. I don't think that changes in the secret sauce that I think other countries really don't quite understand. And then the size of the population and the spending power, all benefits. But I think other people still try to engineer an outcome. And by doing that, you dispirit the pure raw. Does that mean we have to have constraints? Absolutely. But it means you have to let that capitalism go.
That is a positive note on which to end. Brian Moynihan, CEO of Bank of America, thanks for joining Free Expression.
Thank you, Jerry.
Well, that's it for this week's episode of Free Expression. Thanks very much for joining us. I'll be back next week with another one. So please join us then. In the meantime, have a great week and goodbye.